Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and sitting across from me is the one person who gets genuinely excited about net interest margins. Lana Chen, everybody.
I don't get excited, Hudson. I get precise. There's a difference.
Fair enough. Today we are cracking open the Schwab Corporation, ticker SCHW. And folks, this is a company that just finished swallowing a $1.3 trillion whale and somehow came out leaner on the other side.
You're talking about the TD Ameritrade integration. And yes, it's a remarkable story. Schwab now sits on $11.9 trillion in client assets. That number makes them the largest publicly traded brokerage firm in the United States by a wide margin.
11.9 trillion, with a T. That's more than the GDP of every country on Earth except the US and China. So let's give listeners the full picture on this financial giant. Schwab was founded back in 1971 by Charles Schwab himself, originally as a traditional brokerage shop in San Francisco.
The company basically invented discount brokerage. They were the ones who said individual investors shouldn't have to pay a fortune just to buy a stock. That philosophy has been the core of the business for over 50 years.
They went public in September 1987, just weeks before Black Monday, which is either terrible timing or great foreshadowing for a company built to help people invest through anything. Today they're headquartered in Westlake, Texas, with about 33,000 employees and 46.5 million client accounts.
And the business model has evolved significantly. They make money four ways. First, net interest income from their banking operations, which is their biggest revenue driver. Second, asset management fees on funds and advisory services. Third, trading revenue. And fourth, service charges and other fees. The zero-commission trading move back in 2019 was the strategic masterstroke. It killed a revenue stream but opened the floodgates on asset gathering.
And now we've got a new captain at the helm. Rick Wurster took over as CEO on January 1st, 2025. He's a Dartmouth Tuck MBA, former McKinsey consultant, holds both a CFA and a CMT designation. The guy's got more letters after his name than a bowl of alphabet soup.
He joined Schwab in 2016, ran their asset management division, then served as president, overseeing basically everything from technology to wealth management. He inherited the CEO role right as the TD integration entered its final stretch.
And speaking of that integration, let's talk about why Schwab is so interesting right now. The TD Ameritrade deal is done, fully complete, and those $2 billion in annual cost synergies are now flowing through the income statement.
That's the key catalyst. For the past 2 years, integration costs were a drag on earnings. Now that overhang is gone, and you're seeing it in the numbers. Full year 2025 revenue hit a record $23.9 billion, up 22% from the prior year.
All right, Lana, this is your moment. Take us through the numbers.
Let's start with valuation. Schwab trades at about $94 a share, giving it a market cap of roughly $167 billion. The trailing PE is 20.1 times, which looks reasonable for a financial services company growing this fast. The forward PE drops to 15.7 times, which tells you the market expects meaningful earnings acceleration.
That forward multiple is actually pretty attractive compared to the broader market.
It is. Price to book is 4.1 times, and EV to EBITDA sits at 33.2 times. The PEG ratio comes in around 2.2, which suggests the stock isn't cheap on a growth-adjusted basis, but it's not wildly overvalued either, given the earnings trajectory.
And the 52-week range.
The stock hit a 52-week low of $65.88 and ran all the way to $107.50, which was also the all-time high set on February 10th of this year. So at 94, we're about 12.5% off the peak.
Now let's talk about the engine, the revenue and earnings picture.
Revenue for the trailing 12 months was $23.9 billion, growing 22% year over year. The quarterly trend shows steady acceleration. Q1 2025 came in at $5.6 billion, Q2 at $5.9, Q3 at $6.1, and Q4 at $6.34 billion. That's a beautiful upward staircase.
Earnings per share.
EPS for the trailing 12 months was $4.67, with growth of 53.6%. That's explosive. The operating margin sits around 45%, and the net margin is 37%. For a brokerage company, those are exceptional numbers.
53% earnings growth. That's not a typo, folks.
It's partly the TD synergies flowing through. Now for cash flow. Free cash flow came in around $1.6 billion on a trailing basis, giving an FCF yield just under 1%. For a financial institution of this size, FCF isn't the primary metric investors watch, but it's positive and growing.
What about the balance sheet?
Total assets of $465 billion. Total debt is $37.7 billion, which sounds like a lot, but the debt-to-equity ratio is only 0.56 times. Very manageable. Book value per share is $23.86. The banking side carries a net interest margin of 2.90%, which has been expanding as the cash sorting headwinds from 2023 and 2024 start to fade.
And there's a dividend here too, right?
There is. The annual dividend is $1.28 per share, giving a yield of 1.35%. The payout ratio is only 28%, which means there's plenty of room to grow the dividend. They've been increasing it at about 8.5% annually over the past 5 years. It's not a high-yield play, but it's a reliable and growing income stream.
All right, what's the bottom line on financial health?
Overall, Charles Schwab's financial health is strong. 22% revenue growth, over 50% earnings growth, expanding margins, manageable debt, and a business model that's finally operating at full scale post-integration. The numbers tell the story of a company entering its next growth phase.
Love it. Now let's talk about what Wall Street thinks. Of the 22 analysts covering Schwab, 11 rated a buy, one says hold, and one says sell. The median 12-month price target is $111.50, which implies about 18.7% upside from here.
The range is wide, though. Morgan Stanley has the street high target at $148, while Redburn Atlantic is down at $82.
Recent moves include UBS maintaining buy but trimming the target to $119. Jefferies and Truist both staying at buy with targets around $118 to $120. And Keefe Bruyette reinstated coverage with an outperform and a $110 target.
On the insider front, we've seen selling of about 317,000 shares worth roughly $31 million in recent months. No significant insider purchases. The selling appears to be planned dispositions rather than a signal of bearish sentiment from management.
And the most recent earnings, Q4 2025, how'd they do?
They beat. EPS came in at $1.39 versus estimates of $1.34. Revenue was $6.34 billion versus expectations of $6.30 billion. Management guided for continued net interest margin expansion into 2026 and mid-single-digit organic asset growth.
Solid beat on both lines. Now let's get into what could send this stock higher. Bull case first. Number one, the TD Ameritrade integration is done, and those $2 billion in annual savings are now pure earnings fuel.
Number two, they just acquired Forge Global, which gives them a platform for private equity secondary trading. That's a multi-trillion-dollar addressable market, and it's a higher margin business than core brokerage.
Number three, RIA lending is exploding. Bank lending balances hit $58 billion, up 28% year over year. Pledged asset line originations grew 85%.
Number four, the regulatory environment has shifted in Schwab's favor. Basel III retailoring reduced expected capital requirements, and the FDIC withdrew proposals on brokered deposits. That's a meaningful de-risking event.
Number five, they're launching spot crypto trading in 2026 and building out agentic AI advisory tools. Both could open new revenue streams and attract younger investors.
And the organic growth engine keeps humming. They attracted $519 billion in net new assets during 2025. That's client money walking in the door because they want to be at Schwab.
Now for the bear case. Lana, what keeps you up at night with this one?
Interest rate sensitivity is the big one. Schwab's business model is heavily tied to net interest income. If the Fed cuts rates aggressively, that 2.90% net interest margin compresses and earnings take a hit.
And there's the cash sorting issue, right?
Exactly. Clients have been moving cash out of low-yielding Schwab sweep accounts and into higher-yielding alternatives. The recovery has been sluggish. If that trend accelerates again, it pressures the banking revenue that funds the whole operation.
Competition is another concern. Fidelity, Vanguard, Interactive Brokers, they all offer zero commissions now. Schwab's first-mover advantage there has eroded.
Fee compression is secular. Asset management fees keep trending lower across the industry, and while Schwab's scale helps absorb that, it's a headwind that doesn't go away.
And then there's the valuation question. The stock hit all-time highs in February. At $94, you're paying a premium for a business that needs to execute perfectly on its growth plans.
The margin of safety is thinner at these levels. If earnings disappoint or rates move the wrong way, the stock has room to correct.
Let's see how Schwab stacks up against the competition. We're looking at Morgan Stanley, Goldman Sachs, and Interactive Brokers.
Morgan Stanley trades at 16.2 times earnings with a forward PE of 14.6. Revenue growth of 14%, operating margin of 37%, and a dividend yield of 2.5%. They're more of a wealth management and investment banking hybrid.
Goldman Sachs is at about 18 times trailing earnings, forward PE of 13.8. Similar revenue growth around 14%, but a net margin near 30%. They just exited consumer banking to refocus on their institutional strengths.
Interactive Brokers is the outlier. It trades at over 30 times earnings with a forward PE near 27.5, revenue growth of 19%. But here's the jaw-dropper, an operating margin of nearly 77%.
77% operating margin. That's absurd.
IBKR runs an incredibly lean, technology-driven platform. But their business is more trader-centric and much smaller in scale. Only $30 billion in market cap versus Schwab's $167 billion. They're growing fast, but serving a different client base.
So Schwab sits in an interesting middle ground. Not as cheap as the investment banks on a PE basis, not as expensive as IBKR, but with a scale advantage that none of them can match.
Correct. Schwab's $11.9 trillion in client assets dwarfs all three peers combined in the brokerage space. That scale generates revenue diversification, pricing power, and operating leverage that's genuinely difficult to replicate.
Let's bring it home. The bottom line on Charles Schwab. This is a company that just completed one of the most ambitious integrations in financial services history and came out the other side stronger. 22% revenue growth, 53% earnings growth, record client assets, expanding margins. The growth engine is firing on all cylinders.
The single most important number for investors to watch going forward is the net interest margin. It was 2.90% in Q4. If that continues expanding, Schwab's earnings power could surprise to the upside. If rates fall sharply and it contracts, that's where the risk lives.
We want to close today with a quote from Charlie Munger, who said, "The first rule of compounding, never interrupt it unnecessarily."
Hard to argue with the man who spent a lifetime proving that patience and scale are the most powerful forces in investing. Schwab's $11.9 trillion platform is the embodiment of that idea.
That's our deep dive on Charles Schwab, ticker SW, episode 117 in the books.
Try not to compound too aggressively on the way out, Hudson.
No promises. This is Charged Alpha, the S&P 500 stock encyclopedia.
The information presented is for educational purposes only and should not be considered investment advice. Always do your own research and consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street